Under U.S. law, institutional managers controlling more than $100 million in qualifying assets are required to disclose their equity holdings to the Securities and Exchange Commission using Form 13F. However, the mandate includes a specific reporting window. Managers are legally permitted to wait up to 45 days after the end of a fiscal quarter before they are required to make these holdings public. This creates a significant gap between action and disclosure. A trade executed in early January may not appear in a public filing until mid-May, a total delay of up to 135 days from the initial purchase. By the time the public accesses a 13F through the Edgar database, the data is essentially historical. It represents a past state of a portfolio that may have already been altered. Retail investors often overlook this lag, attempting to use these filings as real-time signals to replicate institutional trades at the exact moment the original manager might be exiting the position. Relying on an isolated 13F filing means analyzing a static, outdated snapshot. Without additional context, it is impossible to determine if a reported position reflects a current strategy or a completed cycle. Aggregating thousands of these delayed records allows for the identification of broader capital flows that remain hidden when looking at any single document in isolation. This method allows an algorithmic system to generate a high-level alert, such as the detection of $30.5 billion accumulation in Bank of America. The alert highlights that this capital is not distributed randomly across the market. Instead, it is concentrated within a specific group of mega-cap managers reporting during the same disclosure cycle. The signal is reinforced by the absence of selling. While this specific group accumulated shares, their peers did not disclose any corresponding liquidations that would offset the net movement. The question for an analyst is how a system can derive such a specific signal from public data that is legally permitted to be 45 days old. Understanding the alert requires moving beyond the analysis of individual funds and reverse engineering the multi-node data pipelines used to track these overlaps. Traditional 13F analysis typically focuses on tracking individual managers, often referred to as gurus, to identify their highest conviction investments. Seeing a significant move by a single manager, such as Bill Ackman increasing an Amazon position by $9.1 billion, provides a clear data point, but it lacks the context of the broader market. For example, Philippe Lafont disclosed massive individual allocations, $1.5 billion in AppLovin, $1.9 billion in Broadcom, and $2.3 billion in Amazon. But this single-node view can't reveal if these moves reflect wider consensus or an isolated strategy, leaving observers blind to other institutions exiting. Analyzing single portfolios provides data without validation. It fails to show the cross-portfolio consensus necessary to distinguish a unique bet from a sector-wide shift. Cross-portfolio aggregation solves this by shifting the focus from individual managers to the points where their portfolios overlap. This graph model visualizes a system scanning hundreds of filings to identify simultaneous asset acquisition. As capital flow lines are drawn, a pattern emerges. 4 independent funds overlapping to create a net accumulation of over $1 billion in shared equities.
This configuration is meaningful because it suggests that multiple independent research teams reached the same conclusion about an asset's value during the same reporting period. To refine the signal, the system also checks for liquidations. It ensures that while these funds are buying, there isn't a larger group of institutional peers selling the same asset. By mapping these overlaps, analysts can distinguish between a random, idiosyncratic trade and a systemic shift in how capital is being allocated across a sector. Furthermore, overlap detection can be applied to entire thematic supply chains, tracking how capital moves through interconnected industries. The AI Infrastructure Index maps capital flow through the data center supply chain. Categories expand to reveal institutional capital concentrating in semiconductor firms. Flow lines then extend downward into physical infrastructure, highlighting simultaneous movement into nuclear energy providers like Constellation Energy and Oklo. This shows institutional money moving from digital assets to the physical power sources required to operate them, revealing a sequence of deployment across linked industries. When these allocations happen across distinct sectors at once, the signal suggests a broader macro thesis rather than a simple interest in a single stock. Mapping these convergent supply chains allows analysts to identify shifts in institutional strategy, often before those underlying infrastructure needs are reflected in mainstream headlines. While this data is highly structured, it is important to recognize the specific constraints of the source material. This analysis is based strictly on public regulatory filings, such as the SEC EDGAR database. It is intended for educational research and is not a recommendation to buy or sell securities. Because the filings are delayed, this data does not represent real-time order flow and cannot be used for immediate trading decisions. AI-generated summaries can automate the comparison of these massive datasets, but they do not eliminate the historical nature of the underlying documents. The tool provides a framework for understanding past institutional behavior to aid in long-term research. It does not function as an investment advisor or a real-time signal provider. On its own, a single 13F filing is a noisy historical data point with limited predictive utility. However, through a cross-portfolio model, these individual points connect to form a multi-node map. As the view widens, the noise of individual rebalancing fades. What remains are large-scale clusters, indicating where institutional capital is concentrated. Algorithms do not remove the 45-day delay, but they mitigate its impact by rendering a map of the collective, long-term positioning of the world's largest managers. This macro view reveals the underlying patterns of capital movement that are invisible when examining filings one by one. A single SEC 13F is a record of where money was spent in the past, but the aggregated topology of hundreds of filings provides a map of where institutional capital is being anchored for the long term. Experienced analysts do not use this data to chase the specific trades of yesterday. Instead, they study these public disclosures to uncover the systemic foundations that the largest institutions are quietly building for the years ahead.